like more as I can. Hi, my name is Dana Golden. Welcome back to the second lecture in the natural resource portion of the class. I'm glad you came back to continue this journey as my junior analyst. Let's get you on this desk. Let's get you ready to trade. So what moves futures markets? How do futures markets move? How does the market respond to changes in supply and demand? So obviously, change in production, whether geospatial disruptions affect supply, change in consumption like industrial use, seasonal patterns affect demand, maybe if there are views about what the health impacts of a particular crop is that will affect how people are doing it. And obviously, right now, in terms of consumption, that's not necessarily consumers. Right now, we're seeing a shift towards renewable energies that is changing pretty dramatically the demand pattern, the consumption pattern for most industrial metals. So also another factor that influences futures markets is storage cost. So this influences the shape of the futures curve pretty strongly. We'll talk about the mathematical theory behind that in a moment. But yeah, you have storage cost where normally if there's not a high level of stocks, you don't really care about the cost of storage because it's pretty low. But if everyone's storing this thing and the market for storage is such that there's no supply of storage, now it's very expensive to store the commodity, and you're going to see high short-term price or low short-term prices, high long-term prices. You're going to see a very weird futures curve, like what you saw with the negative oil prices a few years ago. And then, of course, economic indicators, macroeconomic changes the direction of futures markets because people see signals as how it's going to affect the individual markets. And then, of course, you have the market participators, speculators, arbitrageurs who are exploiting price differences between markets. So I didn't talk about them a lot, but there are people who are arbitrageurs who are not making a bet on how markets will move, but are exploiting the fact that there's a difference between two prices. And ideally, over time, this should go away. So market participants work together to move prices in order to manage risk and deal with what the price should be and the physical imbalances between prices. Technical factors, market sentiment. This is reflected in trading volumes and open interest. And of course, open interest being the amount of people who are in the bid-ask spread, the amount of people who put in a bid to buy or sell the commodity. And then price trends, this is moving average, and the amount of trade there in there is an open interest. Moving average, support, and resistance level. Then, of course, you have external influences. Geopolitical events very much affect the price of commodities. You saw this a lot with the Iran sanctions and the Venezuela sanctions. Those both affected the price of oil, and that helped lead to reducing these sanctions with the Ukrainian war. Also, Ukrainian war very much affected the price of Black Sea winter wheat, if any of you are familiar with that commodity. So there's a bunch of things that move futures markets. So how should we think about these movements, and how should we think about the formation of backwardation and contango? The first model we're going to talk about today is the Keynes Hicks theory of hedging pressure, which suggests that futures prices are affected by risk preferences or hedgers. This theory posits that there is a risk premium in future prices that compensates for the pressure exerted by hedgers who seek to offload the risk. This is the idea that there's usually one part of the market, either buyers or sellers, who sees a greater risk in the market and would like to hedge that risk. Normally, in the traditional Keynes Hicks theory of hedging pressure, and this is what I think Keynes was originally talking about and using as an example, you saw that he thought that farmers and producers tended to be more exposed than consumers, and they really wanted to offload risk, which means they were willing to sell in the future date at a lower price than the spot price because they wanted to lock in a price. So this is why normally the futures price is lower than the spot price, and you call it normal backwardation. This is the idea that normally producers are seeking to offload risk. This isn't necessarily true. It might be that there are a lot of consumers in the market who are more exposed to risk, but it's typically true that and this is the first theory of hedging progression that came out. This is the first theory of how these prices formed, is the idea that hedgers are seeking to offload risk and are willing to pay a premium for this. So let F of T be the future price at time T and S of T be the spot price at maturity T. So this is the price at today, and this is the spot price at the maturity of the future price. So the expected spot price, the expected price at some time in the future can be expressed as F of T is the expected spot price. So this is the expected price minus the risk premium. So this is why the spot price is usually higher. The expected spot price is usually higher than the risk premium because hedgers are more exposed and want to get rid of it. And speculators are providing this to the hedgers. Then you have a risk premium, which relates to hedging demand. You can call this alpha, where alpha reflects the demand by hedgers to insure against adverse price changes. If hedgers are less concerned about prices moving against them, you'll see there will be more convergence between the futures and spot price. So example, suppose the expected spot price of wheat in 3 months is $600 per bushel, but due to hedging pressure, futures prices are discounted by a risk premium of $20. Then the future prices can be calculated as the expected spot price minus $20 equals $600 minus $20 equals $580. The future price, this means the futures price today would be $580 per bushel for delivery in 3 months. After you have the Keynes Hicks theory of hedging pressure, you have the opposing working Kaldor theory of storage. And in the working Kaldor theory of storage, you attempt to explain contango and why you see often contango in some commodities. And this theory of storage links commodity prices and the future costs and benefits of to the future costs and benefits of holding, or to the futures by the costs and benefits of holding inventories. Here's the idea that storage is expensive, and the cost of storage determines how much the price is going to differ. So storage cost, convenient yield, the benefits of holding stock. Maybe you're someone who really likes to have a lot of stock on hand to prevent a stock out. Which we talked about last class, how painful it is to not have enough to satisfy demand. Customers get upset when you run out of things. So this drives the futures basis, the difference between the spot and futures price. So mathematical formulation, F of T is the futures price and S of T is the spot price. The future spot price relation can be expressed as F of T equals S of T e to the C minus Y, T to the T minus T, where C is the cost carry and Y is the convenience yield. Basically, the futures price is a function of the spot price and the difference between the value, the cost of having to carry more and store more, and the value of having it today, being able to use it today, which presents a real optionality. So if you rearrange to solve for basis, you get F of T minus S of T equals S of T, and then times the same thing, but minus 1, which subtracts out the spot price. And this shows how storage price and cost and convenient yield impact the futures price. So if storage costs go up, then you would expect the basis, you would expect this term to go up, and you would expect the basis to increase. If storage costs go down, you expect the basis to decrease. So if you see positive basis, normal is because of high storage cost. So here's working Kaldor graphically. You have the convenience yield, how valuable it is to hold some amount of storage, how valuable it is to have some stocks on hand. And here's the marginal cost of storage. It's pretty linear, but then suddenly you run out of storage and now oil is negative. And then here's the working curve, which provides the cost. And that some value, you really want to have some extra amount of the commodity. So there's a negative basis because this is the equilibrium basis of the returns to storage. There's a negative basis because it's good to have storage on hand, and then pretty quickly it converges to the marginal cost of storage, and then eventually the price just skyrockets when you run out of storage. Nice oil prices you got there. It'd be a shame if they went negative. So an example of working Kaldor. Suppose the spot price of oil is $80 per barrel and the cost of carry is 5. We calculate the future price as 80 times e to the 0.05 minus 0.02 times 0.05, which takes into account the cost of carry and the convenience yield we've assumed. Convenience yield we've assumed is 0.02, and then 80 times e to the 0.015 equals 81.21. Futures price for delivery in 6 months would be approximately 81.21, indicating a basis of about 1.21, which is the difference between the spot price and the futures price. And then next time we're going to pick it back up with an introduction to options and options contracts. Hope you have a great day. Thank you.